As millions of small business owners prepare to file their taxes, it burns my soul to know that 90% of them are about to overpay their taxes again. As a CPA, I have seen this happen in so many different ways. They miss easy tax deductions, they forget information, they file late, or they file the wrong forms. They don't pay their estimated taxes. Then the IRS penalizes them, and they pay even more money in fines, in addition to their inflated tax bill that they did nothing about. And now they owe a to the IRS. I have seen people literally create a mess for themselves, financially, mentally, and emotionally. But fortunately, all of this stress can be avoided by following the simple steps that I am about to give you. First, I am going to begin by walking you through the basics that every small business owner needs to know about taxes, like how taxes work, what tax forms you need to complete, and what information you need to gather to file your taxes to begin with. This is going to set this entire video up for me to later show you how to reduce your taxes, how to avoid IRS penalties, and even how you can remove IRS penalties you do not avoid towards the end of this video. I help business owners every single day with things like this at mycpacoach.com. So if you have no clue about where you should begin with taxes, I promise you, this video will help you tremendously. And if you appreciate this information, please do me a favor and smash the like button for me below. Comment if you have any questions, and subscribe if you want more helpful guides just like this. Let's go ahead and jump in. All right, step number one, understand your tax treatment as a business owner. You cannot be smart about your taxes if you do not know what type of taxes you pay to begin with. Okay, so let's make sure you understand this first. First of all, as a business owner, you are taxed on your income after deducting all of your expenses. That part is very important if you do not want to overpay your taxes. Now, how you are actually taxed depends on your business structure. That part is also very important. Most small businesses are taxed as disregarded entities. In other words, all of your business income is simply added to your individual income and taxed on your individual tax return. So if you operate as an LLC, partnership, sole proprietor, or unincorporated business, your default tax classification will be that of a disregarded entity. You will pay individual income tax on all of your income, which includes your business income. This will be taxed according to your federal income tax rate and your state income tax rate. But then there is an additional tax that every one of these entities pay: self-employment tax. Self-employment tax is an additional 15.3% tax on all of your business income up to about $170,000, and then the tax drops to about 2.9 to 3.8% on income above this level. Now, there are a lot of things you can do to reduce these taxes, like maximizing your deductions or simply switching to a different business structure like an S corporation, for example. But it all starts with understanding that this tax exists on your tax return. The only other income tax we have not addressed is the corporate income tax. Corporate income tax is a 21% tax on businesses who operate as C corporations. Now, C corporations file their own tax returns and pay their own tax on their business income. Then when shareholders get paid, they pay tax on their individual tax return as well. So basically, C corporations are taxed twice. S corporations, on the other hand, are only taxed once. S corporations pay no corporate income tax on a federal level, and shareholders only pay individual income tax on their earnings. So at a minimum, now you know how your business entity is taxed, and maybe you have some ideas about switching your entity to change your tax treatment. Just drop a comment below if you want to learn more about that. But this is literally the beginning. There's way more for us to cover here, so let's keep going. Step number 2. Understand the correct tax forms you need to file and their due dates. Your business structure will determine which tax forms you must file and the due date of those forms. Filing the wrong tax form or filing your return late can result in additional penalties and interest, so be sure to save this. You will want to keep this in mind every year for your business going forward. So let's walk through this. Okay, so first of all, if your business is owned by one individual and is not a corporation, then you would just use Schedule C on your individual 1040 tax return in order to report your business financials. So if you are a sole proprietor or a single member LLC, you will simply file a Schedule C. Now, a Schedule C is actually not a business tax return. This is just a supplemental schedule that is connected to your individual tax return, which also means that you would have until the individual tax deadline to file this, which is normally around April 15th of every tax year. For other types of business returns, your tax return is likely due around March 15th of each year. So if your business is owned by 2 or more individuals and is not a corporation, then you would file Form 1065, which is a partnership return due on March 15th. This form would also apply to partnerships and multi-member LLCs, which is just an LLC with partners. And the last group to address would be corporations. S corporations file Form 1120S, which is also due on March 15th, and C corporations file Form 1120, which is normally due around April 15th if the corporation's tax year ends on December 31st. Again, just make note of this for your business structure so you can file the correct forms on time. Step number 3, gather relevant business tax information. Now, this may be the single most important step. If you do not gather all necessary information to file your tax return, you are setting yourself up to miss tax deductions or make costly mistakes on your return. Now, the type of information I am referring to is financial information. Specifically, you need your business accounting records for the tax year. Now, ideally, you would have a profit and loss statement, which clearly shows all of the income your business earned and all of the expenses you incurred to earn that income. If you have this available, then you can proceed to deduct your business expenses to pay less taxes, which we'll talk about in a second here. But if you do not have this available, you are more likely to miss thousands, literally thousands of dollars worth of deductions. Now, this is just not a general practice. The IRS actually requires you to keep up with your business records. As the taxpayer, you have the burden of proof. You must be able to prove any position you take on your tax return, including tax deductions you take as well. Now, the easiest way to accomplish this is to just keep up with your business records. And 99% of people I know who do this just use QuickBooks Online in order to accomplish this. Now, you can learn how to manage all of this yourself, or you can simply hire someone to do this for you. I will include some discount links in my description of this video, one for QuickBooks itself, and another one for the bookkeeping vendor I personally use to manage my own bookkeeping records. But the bottom line here is that you need to have your business financials together in order to successfully file your tax return. Then you can move on to the next step here. Step number 4, reduce your taxable income on your tax return. If you report lower income through your business, you will pay less taxes. Fortunately, the tax law allows you to do this with tax deductions. Regardless of the tax form you file for your business, you can take advantage of this. So let's pull up an example and walk through this carefully. All right, so first of all, when you're filing your taxes, you must report all income you receive through your business. You do not want to get creative here. The IRS has several ways to detect when you underreport your income. But then you can start deducting expenses. Now, just like you should report all of your income, you should aim to deduct as much as your expenses as you legally can. The more expenses you deduct here, the less taxes you will pay. Now, as you can see, the IRS makes this easy for you by listing categories for various deductions you can take, like advertising, car expenses, travel, meals, and so on. But do not go by that alone. There is so much more that you can actually deduct. Just take a look at line 27. other expenses. This is where you can add all other expenses you incur that meet the criteria of a business deduction. Remember this. Section 162 of the tax law allows you to deduct all ordinary and necessary expenses you incur to operate your trade or business. Ordinary just means that the expense is common and accepted in your industry. Necessary just means that it is helpful and appropriate to run your type of business. As a small business owner, you can literally write off almost anything that meets this criteria. This is the tax benefit you get to enjoy as a business owner. To reduce your taxes, you simply need to seek to maximize all of your write-offs through your business. It's that simple. And with organized financials like we just talked about, it should be very easy for you to identify most of your tax deductions. But still, there are several deductions that are less obvious that most people still miss. So make sure you subscribe to our channel to learn more about those. Now, tax deductions help you reduce your taxes, but still, many business owners end up paying additional fees when they file, and penalties, interest, and fines. So let's talk about how you can avoid this and even get them removed. Step number 5. Avoid IRS fees and penalties. There are 3 fees that I see a lot of small businesses fall victim to: the failure to file penalty, the failure to pay penalty, and the underpayment of estimated tax penalty. Let's address all 3 so you do not fall victim to this. A failure to file penalty is exactly what it sounds like. A penalty for not filing your tax return by the due date of March 15th or April 15th based on your business structure. Now, many small business owners intend to file their tax returns on time, but do not actually have their financial information organized and readily available for them to do so, often causing a lot of them to be late. That's you. You can avoid this failure to file penalty by simply filing a tax extension of your tax return. This will give you an additional 6 months from your due date to file your return. And if you do this, you will not pay this penalty. Now let's address the failure to pay penalty. This is a penalty for not paying your taxes on time. Remember this. A tax extension gives you more time to file your tax return. It does not give you more time to pay your taxes. So many small business owners end up paying this penalty because they think the tax extension gives them more time to pay their taxes, but it doesn't. The IRS wants their money and they want it on time. So to avoid this penalty, you must submit your tax payment before the original tax deadline. And if you want to do even better, try to pay your estimated tax liability throughout the tax year, which leads us to the 3rd tax penalty that you could end up paying: underpayment of estimated taxes. So look, if you expect to owe tax of $1,000 or more when you file your taxes, you are required to make estimated tax payments. You are expected to make these payments each quarter. At a minimum, I tell my clients to try to make them all before the end of the tax year. If you do not, you can be assessed estimated tax penalties when you file your tax return. Now, any one of these penalties can be extremely frustrating to deal with. Trust me, I've had my share of playing therapist to get my clients to wrap their minds around them. Now, ideally, you will follow these tips and you will not be penalized. But let's be honest, life happens sometimes. So I want to give you one final tip to help you get tax penalties removed in the unfortunate event that you have to pay them. Step number 6, how to get tax penalties removed. This is something that the IRS does not advertise, so be sure to save this. The IRS provides a first-time penalty waiver. With this waiver, the IRS can waive your entire penalty for failure to file, failure to pay, failure to deposit, or make estimated tax payments. And guess what? All you have to do is call them and ask them about it. You don't even have to provide them with a reason. Now, this is basically a courtesy waiver from the IRS that they typically approve. but they are not going to openly offer this to you. You have to call and specifically ask for the first time penalty waiver. And 90% of the time, I see that they waive this penalty if you are in good standing with the IRS. I have personally wiped out thousands of dollars in penalties from my clients from using this. But just keep in mind that this is a first time penalty waiver, not an every time penalty waiver. So use this wisely. Also, this is not the only way to get IRS penalties abated. They have a formal penalty abatement process where you can ask them to remove your penalties for other valid reasons. For example, they may abate your penalties for having reasonable cause or experiencing a financial hardship. Anyway, I hope this video helps you enough to like this video and subscribe to our channel. And if you need immediate tax assistance, apply to work with a CPA today at mycpacoach.com.